What if you woke up tomorrow morning and discovered that the $50,000 sitting in your bank account could barely buy a single meal? This isn't the plot of a horror movie. It's the uncomfortable reality behind America's $35 trillion national debt, a problem many believe most people don't fully understand. Over the next few minutes, you're going to hear ideas and concerns that many investors and market observers debate, but that the average American rarely hears explained in simple terms. Most of us grew up believing one simple idea, that the US dollar is money. But many critics argue that today's dollar is no longer backed by tangible value in the way people imagine. Instead, they see it as a currency supported by confidence, government debt, and the economy itself. They believe 2026 could become a critical turning point if America's debt continues growing faster than its ability to manage it. History shows that when an empire begins spending more servicing its debt than strengthening its future, it faces serious economic pressure. Many analysts warn that the United States is approaching a moment where debt payments consume an increasingly large share of federal spending. Think about your own life. Why have groceries, gas, insurance, and utility bills become so much more expensive over the past few years? We call it inflation, but inflation quietly reduces the purchasing power of every dollar you earn. When the money supply expands faster than economic growth, each existing dollar can buy a little less. That's why many families feel like they're working harder while falling behind. Now, here's another topic that often creates confusion.
Bank stability during a financial crisis. When you deposit money into a bank, it becomes part of the bank's balance sheet, while you hold a legal claim against the bank through your account. During extreme financial crises, governments and regulators have emergency powers that can affect access to deposits, depending on the laws in place and the circumstances. While insured deposits have protections in many countries, understanding how the banking system works is still important. Around the world, countries are also trying to reduce their dependence on the US dollar in certain international transactions. Nations like China, Russia, India, Brazil, and others have explored trading more in their own currencies or diversifying their reserves. Some analysts believe this trend could gradually reduce global demand for dollars over time, though the US dollar remains the world's dominant reserve currency today. So what choices do individuals have? Many financial experts recommend diversification rather than relying entirely on one type of asset. Assets such as gold, silver, real estate, productive businesses, and diversified investments are often discussed as ways to reduce risk. No investment is risk-free, but diversification can help prepare for uncertainty. From the Roman Empire to the British pound, history reminds us that no economic system remains unchanged forever. The real question isn't whether change will happen. The question is whether you'll be prepared when it does. Now, you may be wondering, doesn't America have a way to pay off this debt? The challenge isn't just the size of the debt, it's the math behind it. America's national debt has surpassed $35 trillion. Broken down across households, that's an enormous financial burden. But many economists argue that the bigger issue isn't the debt itself, it's the cost of servicing that debt. For years, historically low interest rates made borrowing relatively inexpensive. Today, with higher interest rates, the federal government must spend significantly more each year just paying interest on existing debt. This creates what economists call a debt spiral, borrowing more money simply to cover previous
Borrowing costs. If left unchecked, it becomes increasingly difficult to reverse. When countries face this kind of fiscal pressure, they generally have limited options. They can raise taxes, reduce government spending, borrow even more money, or allow inflation to reduce the real value of outstanding debt. Every choice comes with economic and political consequences. But this story isn't just about America's debt. It's also about a changing global financial system. For nearly 80 years, the US dollar has dominated international trade. Oil, commodities, and global commerce have largely been priced in dollars. That worldwide demand has given the United States extraordinary financial advantages. Today, however, some countries are attempting to conduct more trade using their own currencies. Organizations such as BRICS have discussed increasing trade settlement outside the dollar. While these efforts are still developing and the dollar remains the leading global reserve currency, many analysts believe the international monetary system could become more diversified over time.
If global demand for dollars were to decline significantly over many years, it could influence exchange rates, borrowing costs, and inflation inside the United States. The timing and magnitude of such changes remain highly uncertain, but they are increasingly discussed by economists and investors. So what might a serious financial crisis actually look like? Imagine waking up one morning and finding your banking app temporarily unavailable because financial markets are under extreme stress.
ATMs have long lines. Investors are panicking. Banks are facing liquidity pressures. During severe financial crises, governments and central banks typically step in with emergency measures to stabilize the financial system. While scenarios like widespread account freezes are not the expected outcome, financial crises can temporarily disrupt access to financial services and create significant uncertainty. Some people also worry about the future of central bank digital currencies, CBDCs. Supporters argue they could make payments faster and more efficient. Critics fear they could give governments greater visibility or control over financial transactions. Whether and how such systems are adopted remains an active policy debate rather than a settled reality. So, does that mean you're powerless? Absolutely not. History shows that every financial crisis creates both winners and losers. The people who prepare, diversify, and stay informed usually have more options than those who ignore the warning signs. The first principle is diversification. Avoid relying entirely on one asset class or one source of income. Many investors choose to hold a mix of cash, stocks, bonds, precious metals, and real estate based on their financial goals and risk tolerance. Second, focus on real productive assets. Businesses that provide essential goods and services, quality real estate, infrastructure, and other productive investments have often demonstrated resilience over long periods, although they also carry risks. Third, think globally. Diversification across industries, markets, and in some cases, countries can reduce concentration risk. The right approach depends on your personal financial situation and should be considered carefully. Remember the Titanic. While some passengers believed everything was fine until the very end, others recognized the danger early and looked for the lifeboats. The purpose of this video isn't to spread fear. It's to encourage awareness, critical thinking, and preparation. The future isn't written yet, but your preparation today may determine how well you navigate tomorrow. If you found this analysis valuable, share it with someone who cares about protecting their financial future. And if you want more deep dives into America's economy, global markets, and the forces shaping your financial future, subscribe to Bull and Dollar USA.